Well, good morning, everybody, and welcome to the launch of the Benchmark Report for Responsible Investment for Australia, covering calendar year 2023. I'd like to acknowledge the First Peoples of these incredible lands and waters that we're dialing in to from today. First Nations cultural heritage protection is a real focus for RIAA, and we've been delighted to work with the First Nations Heritage Protection Alliance on the Darwin Guides for Investors on First Nations Cultural Heritage Protection. I was delighted to see that in this report, we've seen engagement on First Nations cultural heritage issues increase over the calendar year last year. We're also working on a project mapping First Nations investment markets through our First Nations People's Rights Working Group. I'd like to acknowledge the elders past and present of all the lands that we are dialing in from today, and acknowledge as well that sovereignty was never ceded. Just a disclaimer, this benchmark report contains general information only. It doesn't constitute financial advice. We're not aware of your personal circumstances or your investment objectives, and past performance does not necessarily indicate a financial product's future performance. Well, welcome to the launch of the Benchmark Report. We have already released the organisations that were awarded Leaders and Responsible Investor status. We've announced that already, so today we're going to delve deeply into the report findings. I'd like to thank the report sponsors, T. Rowe Price, Nuveen, AXA Investment Management for their support to RIAA and responsible investment generally across many markets, and also like to acknowledge EY as our research partner this year. Thanks very much as well to the survey respondents, those that filled in the survey. We know it's not easy, and we really appreciate the time and effort that you take to make this research really strong and really credible. So today's session will firstly hear an overview of the report's key findings. Then we'll have a panel discussion and delve a little bit more. I really encourage everybody here to put your questions into the Q&A function of this Zoom webinar. And so we'll try and get to the questions as much as we can during the panel discussion. But first of all, I'm very delighted to introduce Nyanisha Samarakorn. She's the Head of Policy and Advocacy at RIAA, and she's recently taken responsibility for RIAA's research program, working with our fantastic research manager, Bolgan Dandavanchik. Over to you, Nyanisha.
Thank you, Estelle, and hello, everyone. Thank you for joining us. It's really exciting to launch the Benchmark Report for 2024. I just wanted to echo Estelle's thank you to the survey respondents. It is a lot of this data comes directly from the survey respondents, and it's vital that we get that in-depth information. Also wanted to extend my thanks to EY for all their hard work, as well as to Bolgan, who jumped right in this year, and it was a huge help as research manager. So we'll run through the methodology for the research report, and you can see here that we have I think we're at 98% covering the total managed funds for those who are practicing in some way in ESG investing and have publicly proclaimed their commitment to responsible investment. This has been a significant increase, and it is continuing to grow, and really just shows the mainstreaming of integrating that ESG risk into general decision making. We've also got the RIAA that you would know is built up by our responsible investment leaders and our responsible investors who were announced earlier in October. And what that shows is those who are really doing the responsible investing well. What's the funds that are really allocated towards it? Our research universe this year grew yet again to 291. It's the largest that we've had so far. And we've had survey respondents of 66 and desktop research, which is the area that EY helps us with, at 225. So really showing that responsible investing generally, through some degree, is really becoming part of the day-to-day business of funds. Setting the context for what sustainable finance looked like in 2023. I'm conscious that we're towards the end of 2024. Brian, if we could have the next slide, please. So a lot of these have developed a bit further, and we'll talk a little bit about that in the panel discussion. But it was a big year in terms of global highlights, a lot of focus on disclosure with the global disclosure standards from ISSB, the European Sustainability Reporting Standards. We also had the CSDDD coming out of the EU, moving from disclosure into that due diligence aspect, particularly around human rights. We also had significant progress in Asia as well, with Japan, Hong Kong, Singapore, and China. TNFD recommendations were published, and there are undoubtedly a lot more that are not included in this report, and really it is it's a report in itself in terms of those global developments. The Australian focus was really around disclosure, lots of policy around from government directive, that building on that momentum from the last election. So we had significant consultations in 2023 around the draft sustainable finance strategy, the draft Australian Sustainability Reporting Standards from the Australian Accounting Standards Board, as well as consultations on the legislated superannuation objective, the mandatory climate reporting regime, as well as we've had a number of greenwashing regulatory interventions and ASIC's first report into greenwashing interventions. We had more focus from government in terms of relationships in the geographical area, with the first 2+2 climate finance dialogue. This was a meeting between the Ministers of Climate Change and Ministers for Finance between Australia and New Zealand, really solidifying that relationship between the two countries. We also had the development of the Net Zero Economy Agency ahead of it becoming an authority, really to develop the regional capability around net zero. And RIAA hosted the Australasian launch of the TNFD and remains the regional convener in this space. There is a lot that has happened in 2023. There's a lot that happened in 2024 and a lot more to come in 2025, and really setting up that the framework in which responsible investing will continue to occur. Looking to the market itself, we can see that the total managed funds have risen to 3.9 trillion, and the market share of responsible investing, consistent with the development of investors that are engaging in responsible investing, has increased 41%. The average proportion of that the AUM that's being allocated has increased amongst institutional investors. And what we're seeing across the board is that there is the mainstreaming, followed by the opportunities that the policy frameworks are providing for those who are engaging in responsible investing. Going towards the RI leaders and responsible investors. So RIAA updated its scorecard last year and had the new designation of responsible investors to really respond to the fact that this market is growing, and what it takes to be a leader needs to continue to grow. So this year, to become a leader, you needed to score over 16 out of 20, which is the highest mark that we've had in our scorecard, or the highest requirement that we've had in our scorecard. The investment managers that we assessed in the report grew, and along with that, we had a growth in responsible investors as well. And this is the growth in responsible investors far outshone the growth in the research universe, demonstrating that more investment managers are undertaking better practices of RI and really recognising the opportunities that does bring. We had 61 RI leaders, 29 responsible investors, and we had 11 and 9 RI leaders and responsible investors join the cohort for the first time, which is really great to see. The scorecard itself, if you haven't seen it, and I highly recommend that you take a look, it divides up the areas into 4 pillars And what this really shows us is that to be a leader, it's no longer enough just to commit to responsible investment. It is really important to take those positive steps, to be strong stewards, and to actually allocate for positive change. And we've seen that shift year on year through the scoring on the pillars as well. And the difference between non-leaders and responsible investment leaders continues to grow in Pillar 3 and Pillar 4, just demonstrating that to be a strong responsible investment leader, it is really around those positive outcomes and the active engagement. Moving on to the transparency, this was a really great outcome to see, particularly in Australia, where outside of superannuation, we don't have mandatory portfolio holdings disclosure. And even at the superannuation level, it is down to only the holding itself as opposed to asset level. But we are seeing 60% of asset managers disclosing their full fund holdings, which is up from 50%, and that 10% shift within a year is really great to see. And also, investors are less likely to do partial disclosure and more likely to disclose fully. This may also indicate international practices where their full portfolio holdings disclosure is pretty common, and that needing to align internationally, which we're seeing more and more as responsible investing is making the world smaller. On performance of RI products, so last year there was in recognition of the volume of certified products, there was a movement towards looking at the responsible investment products through certified products. And what we see here is that we have a more and more over the medium to long term, responsible investment products are outperforming the general market. The average benchmark across the Australian and international equity classes stayed fairly steady. However, we are seeing that the RI funds are outperforming over the 5 and 10-year markets. And even if you have a look at the 3-year markets for overseas equity funds, the changes, even though it's outperforming, are really close. So what we're seeing is that as good at or better performance from those who are certified, and anyone who is certified will tell you that that process is not easy. So it's really good to see that boost in quality of RI is reflected in the performance against benchmarks. Looking closer at the approaches, so this year for the first time we used the updated GSIA global definitions for RI approaches. So this was released in November 2023, and RIAA is a member of the Global Sustainable Investment Association, and it is, along with CFA and PRI, the GSIA, the group collaborated to publish global definitions on RI approaches, recognizing the call from regulators internationally that industry had to move to provide some of these definitions and to adopt them across practice. So these definitions have been reflected in RIAA's updated RI spectrum, which you can access on our website or through that QR code, and the benchmark survey and report this year. So we've really tried to align them to these approaches and to explain, use those definitions to explore the findings that we have. So the 7 RI approaches are ESG integration, exclusionary negative screening, norms-based screening, stewardship, positive best-in-class screening, thematic investment, and impact investing. And some of them is a bit of a name change. Others are really just refining that definition of what it takes to demonstrate that approach. So the AUM that's been covered by the 7 RI approaches in 2023. Next slide. Thank you. We see here that, consistent with previous years, ESG integration, screening, stewardship remain the most widely adopted RI approaches, continuing to grow. ESG integration now covers 99% of the AUM of the survey respondents, really, again, demonstrating that to undertake any kind of responsible investing, that ESG integration is a minimum bar. And while negative screening remains the most popular type of screening, we are seeing a significant increases in proportions of positively screened and norms-based screened assets under management, demonstrating again that move from not just exclusion, however, just towards more active and positive outcomes through the RI approaches. Delving into this a bit deeper, when we look at ESG integration, we see that more asset managers are applying this across their range of asset classes, up 6 percentage points from last year, or 2022 data. And we also see that 70% of asset managers now have dedicated ESG staff and internal ESG or responsible investment team. And measuring that capacity build is really important, particularly as we move into a highly regulated and disclosure-specific space. Skills and capability will continue to be a primary aspect of what differentiates good RI practices, and those that have room to improve. And this is really around that systematic approach and demonstrating that ESG integration is continuing to be broadly applied across the sector. On stewardship, we are seeing that increasing trend towards transparency. This was previously called corporate engagement, and the focus of stewardship, and you would have seen in the previous one that the stewardship rate of use is really high, however, or the rate of application to AUM is high. However, the focus here is really around the reporting of those activities and outcomes, and understanding the impact of stewardship activities. And we are seeing that increase from 41 to 48%, but there is a bit of a way to go in terms of building transparency in the stewardship space. And in terms of the focus of stewards, with their investee companies, 86% prioritise climate change. This isn't really a surprise, and it continues a trend that we've seen in previous years. The climate change is very much the main focus. However, what was interesting was that diversity and inclusion was the second most engaged in area, demonstrating that there is a preference for well-managed and well-governed, diverse corporates and businesses, as well as the protection of Indigenous people's rights and cultural heritage protection, increasing 6 percentage points from 50%. What we see here is that while climate change is definitely number one, a number of other social and non-climate related environmental factors continue to be strong themes that for stewardship. And this indicates that there is a growing need for better information around some of these non-climate focused areas. On negative screening, as I mentioned, this is the most popular, most widely used screening practice. You can see from the diagram that the sectors that are screened is vast, and this particular diagram really delves into the exclusions from fund managers versus the issues that Australians really want to avoid when investing. And that information is derived from the Values to Riches consumer research report that we RIAA released at the start of this year. So it's current information from 2024, and really demonstrate that while there is some overlap, there is definitely opportunities in terms of meeting consumer needs in this space from screening. The focus on weapons from fund managers, as well as animal cruelty and human rights abuses being the top issues that Australia wants to avoid. So what this indicates is really the opportunities that are available. On norms-based screening, this is really around screening methodologies that focus on a specific treaty, convention, a particular norm that fund managers are looking to avoid or support. And the most popular international convention was the UN Global Compact and Paris Agreement, pretty consistent, identical to last year. TCFD and UN guiding principles continue to be remaining popular norms-based screening categories, as well as what we're seeing here is that there is it's staying pretty consistent around the norms, and this may indicate that there's a growing acceptance, or there is sort of that consolidation of this approach. On positive or best-in-class screening, this is an approach that is applied mostly at the product level. And for this one, we looked at the AUM that was screened in 2023 against a particular theme, as well as the popularity of that theme. So the percentage of survey respondents who selected the specific theme. And what we're seeing is that, again, climate is pretty front of mind with renewable energies, green property, around sustainable companies as well, and that sustainability of business into the future, as well as others which are related to the more nature, biodiversity, sustainable water, reuse, recycling, and respect for human rights. So in terms of AUM, respect for human rights interestingly was a higher allocation, and that transition and risk management. So what this generates is really around where the funds are being allocated and the popularity of the themes that are being applied across the market. Moving on to sustainability themed investment. So 75% of respondents are incorporating sustainability themed investing, which is great to see. Again, moving into that more broader or more specific themed investing. And again, we see climate change, nature, biodiversity really come out on top in terms of popularity, and in terms of AUM that has been screened with sustainability themes. Climate change, renewables, energy efficiency is by far and away the highest theme. Staying on sustainability themed investment, this really looks at, again, the consumer data that we have from the 2024 consumer research RIAA conducted, looking at what do Australians care about when they invest, and then what are the sustainability themed investments that are popular with investment managers. And there is an overlap between the climate change being a real strong alignment between public interest as well as the institutional investment. However, there are other opportunities around sustainable water, healthy rivers, oceans, waste management, sustainable land management, healthcare. Some of those really do come under a broad nature, repair, biodiversity. However, this may be where the communication around what is being targeted may be really useful for consumers who are drilling into that sustainable water, healthy rivers, oceans, or waste management, zero waste. On impact investing, we saw impact investing really focus around clean energy. We're growing to 25.57 billion, and the target areas remain climate change. And really what we're looking for here is, this data is provided by Kanga News, and what we see across is the impact of large issues and larger managers on impact investing. And the growth of impact investing is good to see. Again, that movement away from wholesale exclusion into more of that proactive methods and RI approaches. Next one, please. Thank you. We looked at the key drivers and deterrents of the RI market, and again, this is through our survey respondents. And what we found was that key drivers this year was that demand from institutional investors, inclusion of ESG in risk management process, really growing from last year, showing that really the role that institutional investment plays in moving the dial when it comes to responsible investing, as well as the deterrence, the greenwashing playing a really key role this year, likely from the discussion more generally, as well as from regulatory actions and the focus from policymakers on greenwashing in particular. What was really good to see was that performance concerns about RI dropped this year significantly, and this is really that this was good to see in terms of noting that the performance of RI is really performing at or better in the medium to long term than the general market or average benchmarks, and showing that has been picked up by investment managers. So we are really seeing that movement away from performance being a factor into that more concern around regulatory and policymakers. And so this year we launched our Responsible Investors Leaders and RI Leaders separately. So a really big congratulations to the Responsible Investment Leaders for 2024 for Australia. We had 11 new responsible investment leaders, which is really great to see. Like I mentioned, the bar keeps raising because it is the top 20% of the investment managers in the research universe, and what's required to be in that top 20% keeps growing, which is what we want to see. But we are also seeing responsible investors continue to grow, outpacing the growth of the next slide, outpacing the growth of the research universe. So what this demonstrates is that within the research universe, more and more investors are moving into doing RI better. And with that, I'm going to hand over to Estelle, who is going to take us on a panel discussion with some of our leaders.
Amazing. Thank you so much, Nyanisha, and thanks to also the other reports authors, Bolgan Dandavanchig, Emma Hurd and Sally Shepherdson. So to help us delve into some of these findings and more, we have with us Carolyn Ramskar. She is ESG Investment Specialist and Vice President of T. Rowe Price International. She currently represents T. Rowe Price's responsible corporate governance teams, and she supports the firm's impact suite of products. She comes to us with over 20 years' experience in financial markets. Also, Christina Hermansen, welcome. She is Head of Asia Pacific and Africa at Nuveen Natural Capital. This targets growth in the region in farmland, timber and nature-based investments. She has more than 25 years of international leadership experience. Fantastic to have you both, and Nayanisha has agreed to stay with us for this chat. Now, please put your questions in the Q&A function. There's already a fantastic question there, which we'll get to in a moment. But first, I just wanted to talk about the growth of the market that this report is clearly showing. And I might ask you, Carolyn, first. The growth of the market has increased to $1.6 trillion, or 41% of the market here in Australia now. So more of the market is self-declaring as practicing responsible investment. Why do you think that is?
So it's a great question, and it's really positive to see year on year. I think there has definitely been some fairly significant regulatory and domestic policy changes and signalling of intent in Australia, but we know that regulation isn't always the only thing that causes this shift. There's very much change in demand, I think, in awareness from clients. We're hearing that very much live on the ground, and an understanding of responsible investment and what benefits these strategies bring when incorporated into investment practices. I also often quote the Values to Riches survey by RIAA. I know that's not the one we're releasing today, but that has some great proof points from I think it's roughly 2,000 people that were polled in there about people's changing awareness and understanding, and awareness of responsible investing is at an all-time high in Australia. So I think it's a couple of factors, but very much helped by the fact that the direction of intent of the government, more transparency, information, disclosures coming. And then probably where people are looking globally, seeing that this isn't just about what we're doing in Australia, it's also a global direction of travel.
Great, thank you. And that Values to Riches report can be found on the RIAA website under the Research tab. I might ask you, Christina, as well as Carolyn. Christina, if you wanted to comment on that, please feel free. I do have a question around stewardship as well, which has surpassed ESG integration as the most widely used responsible investment approach last year. So first of all, how important is it to be transparent about stewardship objectives and activities? We're also seeing this kind of increase in transparency of stewardship.
Yeah, well, I think the question is actually a nice link back to the previous. I think it's that transparency that's really building momentum around responsible investing broadly. As many know, Nuveen is well known for responsible investing across a broad portfolio. I have the chance today to speak kind of deeply in a vertical, and I think transparency fits quite nicely with natural capital. So, you know, why is it important? It builds credibility. It demonstrates progress and improvement, because some of that transparency through methodologies is still in early phases of development. It provides the opportunity for education with investors, and then a deeper understanding of the asset class. So how we do that within Nuveen Natural Capital is obviously through reporting, through advisory committees, and very engaging conversations. And what we actually report is, you know, linked to third parties that we reach out to validate what we're doing. We have, for example, developed a nature positive farming framework that's been developed with a third party, and that is a framework that's very global in terms of transparency, but allows local inputs as well. And we find, you know, that kind of level of transparency to not create confusion within it, but delineate local, global, and portfolio level outcomes is very helpful.
Thanks, Christina. Carolyn, can you talk to the importance of transparency in stewardship activities?
Yes, absolutely. And it's very much fundamental. I think people want to know what asset managers are doing on their behalf. And I think it's really important, particularly that surfaced through the report, the transparency that's required to really give people, I'd say, trust and confidence in these activities. It's really important. So at the firm level, there's lots of summaries published, but also at the fund level, there's periodic reporting around proxy voting outcomes, engagement outcomes, specific to strategies. And also these big set piece reports that a lot of asset managers are doing are really helpful. I find not everybody reads them. And at times because they're so weighty. So I think it's very much, again, for the asset managers to make this digestible and deliver it out in a mechanism which the underlying client base can read, digest, and really see weasel up diagrams and visualizations to show what engagements were carried out. Another addition that we've been working on is targeted or capturing the targets of the engagement to make sure there's outcomes for the engagement. To be clear, an engagement isn't just a conversation, it's not a letter, it's not just a chat, it's got to have a purpose to it, there's got to be a definite objective, and then something that's tracked and measured. And we've been able to track this all in-house and start to report that back to our clients. So I think it's getting into the deeper weeds as well, what outcomes happened as a result of that engagement, whether it's one-on-one or a collaborative initiative, particularly on nature-based and some of the newer developing, I'd say, frameworks that we're talking to companies about where people may join in together. It's really important to show that that's having an effect in the industry.
Great, thank you so much. It's really interesting. I think that trust and transparency is absolutely crucial, particularly at the retail investor level, where through our consumer studies, we're seeing more and more people concerned about greenwashing. They're concerned about making sure that they understand really what they're invested in, and that, you know, transparency is really key to giving them that information along with third-party verification. Turn my camera off. Okay. Can you hear me? I'm so sorry. I think I cut out. I was just asking you there, Christina, to expand a little bit about your nature work, given that nature's emerged well and truly as a key theme for responsible investors.
Sure. Within Natural Capital, we really have moved to focus on a very holistic approach, which includes not only nature, but climate and people and productivity across farmland, timberland, and nature-based solutions altogether. As many of you would be aware, when we have kind of a challenge of achieving from a 2010 to a 2010 baseline to a 2050 target, delivering 200% more fiber and timber for housing, 100% more protein and 60% more calories. That holistic approach is extremely important. We look at land-based management and land-based assets through that lens of best value, best use across the asset. Productivity is really key to remain core, to deliver on a fiduciary duty of returns. But looking at a landscape, we do see opportunities here in Australia, quite unique with the New South Wales Biodiversity Conservation Trust. We have been quite engaged with the nature repair market and keen to see some of those first methodologies brought to life. We have some of our own experience in projects where you can see projects that have certainly significant biodiversity benefits as well. And yeah, I think this is it's a good example of an emerging space where natural capital accounting, coming back to the last question on more detailed transparency, is also helpful to really be clear on a balance sheet of what's available in an asset as markets and methodologies continue to develop over time.
That is amazing. Thank you. And I know sort of the work that RIAA's Nature Working Group has been doing to kind of amplify some of these issues as well. It's certainly strong interest across the sector, not simply from those that are focused more kind of acutely on natural capital issues. Did you have a comment on that, Carolyn, or perhaps you can expand a bit on some other themes that you're focused on in your stewardship approaches? And you are on mute. Oh. I think Carolyn might be finding it a little bit difficult to get off mute at the moment. So we'll move on to another question and then come back to you. I think perhaps Christina's sticking to that stewardship. You know, we're often asked for case studies and those that are, you know, doing this well and seeing results. What are some examples of successful engagement within Nuveen?
Yeah, as mentioned before, within the natural capital space, yeah, certainly more detailed reporting. I think when that comes out, you know, kind of into performance, it is really linking back to the fact that the more detailed transparency, the more detailed metrics, more deeper understanding and management of risks that's enabled by the approach really ultimately creates more resilience in an investment strategy. That's demonstrated again in the example of, you know, my vertical through historically a farm may have had a capital appreciation and an operating income revenue stream. Nowadays, it has much deeper in terms of ACCUs, possibly biodiversity, renewable energy integration.
Yeah. Picking up on that point about performance, I think it's a really important one. We did see funds dip slightly in 2021 due to Russia's invasion of Ukraine. We've seen performance of RIAA certified funds certainly continuing to hold strong, as the findings of this research shows. Can you comment a little bit on that topic, Nyanisha, and perhaps you can talk a bit more broadly, Nyanisha, about the benefits of doing responsible investment well?
Sure. Thanks, Estelle. I think it's really clear from the report that we are moving away from this sort of artificial notion of having to sacrifice performance for really wanting to engage in responsible investing. And part of that is the external factors, the policy changes, the opportunities that has been introduced not only by other investors and corporates and businesses who are looking to take advantage of this transition to a decarbonised economy, but also from a policy perspective, we are seeing a lot of government investment into this transition, and it is that investment is going to translate into better, longer, higher returns for consumers and retail investors as well. Ultimately, responsible investing is just another way of saying effectively a resilient model, you know, building resilience, particularly in the face of that growing policy and regulatory change, but also in terms of natural disasters, of effects of climate change, of effects of nature and biodiversity destruction. What does it mean to be a business in 2030 when those effects have taken place? If you're thinking about that now, chances are you're going to build a stronger, more resilient, more sustainable, you're going to be existing business. And I think that's really the key factor here. It's really around that factoring the non-financial risks into that decision making, which builds resilient funds, and then through engagement builds the resilient businesses, and you end up with a stronger economy overall, and ultimately the benefits flow down into or flow through into retail investors and consumers. And what we've seen also from the performance is the rigor through the certification program in building that capacity within funds. So the RIAA certification program certifies products, but through that, it's about you know, understanding the business itself, and there are as well as who is in the business, is there enough capability, what is happening within the business to really support a product like this, and then we can end up with matching up with the disclosure and what the labeling looks like. So really a factor of improving the product that's been offered, but it is really around that resilience. I think sometimes we get a bit distracted with ESG and responsible investing, but when it comes down to it, it really is around a risk model.
Thanks, Anisha. Caroline, I might ask you to comment. You've been through RIAA certification. Perhaps you could make a comment on that third-party verification process.
Yes, absolutely. I also just wanted to chip in to echo the comments made that from a return perspective, and I think this is what we're all here today to show that you can do both. It's I'd say better for the industry in general, having the direction of travel set by things such as labelling, which I know we'll probably come on to, where you have RIAA certification, where there's a standard to uphold, where you're really sorting out good quality implementations of funds. So when people talk about the return perspective, if a fund is implemented well, so you have whether it's impacting some outcome-driven objective alongside a financial return, it's making sure that you're working with those companies that have good access to management, good corporates that you want to work with, and are very open to engagement and discussions on moving forward. You've got policy and regulation going in the right direction, and you're really finding those, working to have those companies that are well positioned for that. So I think that was just something to say that we all recognise you can do both, and then it comes down to how do you sort out what good looks like, and the RIAA certification just works as a good, I'd say, shorthand. There's a lot of clients that we wouldn't be in the room with if we weren't RIAA certified. It's external, it's not easy to get, it's a pretty long, exhaustive process at times. It's not evergreen, you have to keep reapplying for this, and it really makes a corporate look inside itself, and things such as language that's used, accessibility of information, and really think about the client's lens, particularly where retail investors are concerned. So I think it's just that badge, that validation that the industry is looking for, and we know there's a whole host of other things that will come, but it's one that's very much recognised in Australia, New Zealand, across. We're finding as well institutional clients, not just intermediary or wealth management funds as well. So it's got that broad reach as well.
And leads to improvements. That's great. Thanks, Caroline. I might stick with you. There is a question in the chat here about fixed income products. Are there sufficient increases in product availability in the fixed income space?
Well, I wholeheartedly say yes, given it's something that we always find that we end up talking about equity. So I'm delighted to see a fixed income question in here, because responsible investing and all the efforts that we're all working towards is across the asset classes, and you can do some really cool things with fixed income. It very much involves asset managers really utilising their investment teams in a similar way that you would approach equity engagements. You can engage with sovereigns, for example. We worked on some sovereign engagements with Brazil that were in 2023. So talking about deforestation, we're working with, on the equity side, companies and corporates, one of them being Minerva, who's a big beef producer, looking at deforestation and how they capture insights and tools that they use to meet their targets. But we can also engage with the government of Brazil, who we encourage to set targets around deforestation and improvements that are needed to be made, and encourage Brazil to think about ESG labelled bonds, which towards the end of 2023 they started to issue. There's also some blue bonds that have come to the market. So we've been working with the IFC on a blue bond fund across emerging markets. So looking at ocean health, but also the technologies that could help improve this. So looking at water both above and below the ocean. So really helping to address the UN SDGs and really tackling money to projects that help with ocean conservation. Same for rhino bonds. So the World Bank rhino bonds, these conservation bonds that have dual outcomes, there's conservation projects which help the black rhinos, but also job creation in South Africa. We invest in those through some of our fixed income impact funds and across other strategies. There's an Amazon deforestation linked bond. So outcome driven fixed income investments are proving to be really popular, but they're also very direct. You can actually see and measure because a lot of these investments really are predicated on the use of proceeds and then the post-reporting, post-issuance reporting. So really tracking those outcomes. So as much as I love talking about equities and what we can do on that side, with fixed income, you can really get to the heart of the outcome that you're trying to effect change in.
Amazing. That is really encouraging and so diverse, looking at those science-based, oceans, rhino bonds, Amazon restoration bonds, and so on. Incredible. Christina, there's a question here about instos. What's driving instos to seek more RI investments? And are superannuation members really seeking RI explicitly? Perhaps you could comment on that, Christina.
Yeah, a few thoughts. And, I think from what Caroline just said in terms of the breadth of offerings and opportunities, that already speaks quite a lot to the question. I do think we've talked a fair amount about the resilience and responsible investing, just simply a better risk management and understanding. I think any superannuation members, including myself, that's what we're seeking. And so it naturally kind of aligns with this longer term security of returns. I think there is more offering that's out there beyond just fixed income as well. And ultimately, I do think the institutions, they have the fiduciary duty. There's your future, your super, where greater returns and better risk management is very well aligned, with the benchmarking that's there. So those are a few thoughts, if anybody wants to add on.
Really interesting stuff. We're looking at your future, your super at the moment with the government and some of the risks around that benchmark hugging, and would love to have that conversation with you. I might move on now. I really want to touch briefly on greenwashing, because we have seen the regulators focus on greenwashing over 2023, appearing to have prompted the industry to become more cautious about claiming sustainability objectives in funds. What are you hearing in the industry around that?
Yeah, I would highlight two key themes: seeking education and as you said, caution. So the positive thing certainly for what we're offering to market is that education piece, having deeper conversations with the RI team, seeking to understand the frameworks, how they're developing, what are the best possible certification methods out there. There's probably some good internal thinking about impact type of frameworks and validation of those. And yet there's probably a pullback from actually calling it impact, with a concern on greenwashing. The caution also comes from wanting to understand complex and new phrases. Think about regenerative agriculture, sustainable agriculture, responsible agriculture, just as an example. Definitions around those things are extremely important in greenwashing, again, just as one example. But all in all, I do think the enhanced education, a little more caution and care, whether we are calling strategies impact, value add, or core plus, because those are a little bit easier to accept. It's all coming to more resilient and enhanced returns.
Carolyn, transparency is obviously key here. This report is certainly showing a greater commitment to transparency amongst institutional investors in Australia. What do you think would help further improve this?
Well, I think what would help is possibly on its way. So with transparency, it's very much about making sure that the end investor can make the right choice. It's there to support people in investment making decisions. And I think having more information, having consistent information across the piece will be helpful. So I think, to really echo Christina's point, there's a lot of education needed around this, and this is where we all have a role to play supporting the client base, but particularly where disclosures are coming. So more information, more quality information that's consistent, comparable, coming out into the market next year, particularly around climate. And then there's further disclosures that can be made. We know that the ISSB, who we work on the advisory group there, looking at TNFD, so the Task Force on Nature-related Disclosures, being wrapped into ISSB. So as much as we talk about some of these considerations, nature, biodiversity, deforestation, it's really hard to quantify what that looks like. It's hugely qualitative at times, qualitative. So just ensuring that there's more data coming out in a consistent way on the nature-related disclosures down the line, in line with what's coming with climate and ISSB, will be really helpful in making investment decisions around whether a company is progressing in the right direction or not, and just what kind of investments you want to hold. And then also to really cement that a good labelling regime underpinned by disclosures is what we've seen start to be rolled out, particularly in the UK, which has been an experience and one that I'm sure the Australian regulatory teams are looking at. But also the one thing I would say is just making sure that the support around any of these changes, that people really understand how to disclose information, but also how to consume it as well. I think that would be really helpful. There's a lot of information already there.
Indeed. No, Anisha, I might ask you to comment, given you're RIAA's head of policy and advocacy, we're very close to those policy and regulatory developments in our market.
Yeah, that's right. And I think I echo and agree with everything that Christina and Caroline have mentioned. One of the things that we really want to make sure is information is great, and transparency and having that information, and also one of the only ways of having the consistent degree of information is through that policy change, that legal requirements that says here is the minimum expectation that everyone in the market has, which really can be a benefit to those who are doing it well, to know that there is an expectation of the rest of the market, but then also for those who would like to do it but may not have the resources and the background and the skills and capability. However, there is also a such thing as drowning in information, and information is only as useful as the quality that's provided, as well as the ability to use it. So I think coming back again to the core objective of all of this is to slow down the rate of global warming and emissions. The core objective is to prevent nature loss, biodiversity destruction, having more and making sure that we are not just disclosing, we being the sector, not just disclosing for the sake of disclosing. There is that functional element. How is it going to be used? How is it going to be used by investors? How will it be used by the company itself? As well as retail investors and consumers. We know that in this space, potentially, unlike a lot of other spaces, a lot of retail investors and consumers are highly engaged. They want to know the ins and outs of how their values are being met by their super funds, their managed funds. The ability to micro-invest, to engage with platforms means that we have retail investors and consumers who are engaging a lot more than they might have in the past. So that information really needs to come with that usability element. And again, keeping that core intention in mind of actual reductions of what we're trying to address. On transparency, there are some things that, and I mentioned this in my overview, that we are still behind on, such as full portfolio holdings disclosure, which is a real international alignment issue as well for some of our members, because there's an expectation that's provided in other jurisdictions. It's a pretty common requirement that we just don't have at the degree that we really need to have it. And I think one of the benefits of the certification program is that requirement to have full portfolio holdings disclosure publicly available. And we see that our members are more than happy, capable of providing that information. So really, we now need kind of that legislative intent, that policy intent to drive it across the sector, and to have that degree of granularity in where that the money is going. And so I think in terms of that information aspect, transparency is absolutely key, but we really just need to make sure that we are, focused on that, on how that information is going to continue to be used.
Christina, did you have a comment on any of that before we move on? So I'm really keen to talk about sustainability skills and capability and capacity.
I would only emphasize totally very much agree. I think to underpin two points, consistency is so key because you also need to avoid any setbacks. Piloting and scaling from piloting and using things like the RIAA Nature Working Group for kind of cross-sector learning, I think is so key. And then just the other thing is, there is some, I guess, transparency out there in these emerging ecosystem services markets like ACCUs, where you're seeing, some methodologies and some projects getting a premium over others. So the market's determining for itself as well in some areas.
It's amazing to see. Look, moving on, as I mentioned, the sustainability skills gap is something that we quite often hear about in RIAA from our members. However, we have seen that a lack of understanding or capacity to apply responsible investment is no longer as much of a concern amongst investment managers as it was. How do you think this could be at the moment, given that we do have a whole lot of, complex regulations, internationally disclosures that managers have to navigate, and so on, against this backdrop of a greenwashing environment, and so on? Are either of you able to comment on that?
Sure, I'll give it a first start. I think what has changed over time, certainly in natural capital, but I would expect in many asset classes, is we've moved from kind of a core of experts learning about methodologies, supporting how that implementation would happen in the organization. And with that maturity, there's now a realization we've got to embed that capability all over the organization. So bringing that to life for us today, we have a very strong and mighty team centrally. They provide thought leadership, input on global methodologies, but it's the team on the ground, very diverse: agronomists, ecologists, soil scientists, asset managers, analysts, that really have to bring things all together. So I think there is a little bit of divide and conquer strategy and execution that's probably happening out there. I do think it's an extremely exciting place to be, and we've probably learned over the last couple of years to leverage different skill sets, whether it's kind of from a policy advocacy background or, a highly analytical kind of background. But as we continue to develop, as we were talking about consistency and creating methodologies, which will be kind of freedom in a framework for different types of investments, systems thinking, communication, collaboration. It's certainly a place I'd like my daughter to be in the future.
Good tip. We do have 70% of asset managers now having a dedicated ESG team. I thought your comments around sort of systems thinking and also integrating this stuff through the organisation was really important as well. Carolyn, can you talk a little bit about what you think the skills are that we'll need in sustainable finance over the next few years?
Yes, absolutely. And also just to echo the comments about baking this in and embedding through an organisation, because it's really important that for real sort of change or assets to start moving towards sort of sustainable, responsible investing at scale, you really need investment teams throughout the organisation to really be looking at these factors and thinking about this. And having specialist teams is fantastic. So you're developing that knowledge, you're building things out and the models and the tooling, but making that available and organically making that through the investment process will be key. So the skills are very much investment skills, quantitative and qualitative across the piece. So we have a dedicated team of about 41 analysts across the piece on responsible investing, but there's a couple of hundred analysts on our platform that this supports, and they all have access to the same tools, the same information, the holding level, the portfolio level. So it's also pushed out on their desks for them to look at daily or whenever they need. And so having that accessibility in the research platforms and having that understanding across the business, baking that in to how people's compensation at year end is considered. What kind of training do they receive when they join? What kind of ongoing engagement do they have? So, for example, if we have an engagement with the company, it's an open door policy. Members of the responsible investing team, the analysts, and the fundamental equity or fixed income analysts can go along to that engagement. So they're often co-engagements, quite a lot of them are. And it's ensuring that it's not just hived off as specialist skills in one part of the business. One point to note though, handling data and how that's pushed out through the business is interesting as well. There's a lot of tooling that's needed around this as well. So it's making sure that businesses are really set up, not just in the people, but also in their infrastructure to absorb this data in the same way that we're saying from a client perspective, there's information out there, but how do you then consume that? And as an asset manager, it's really important that you have the right frameworks, tools, systems in place to be able to talk your clients through this and evidence through reporting. So there's a lot of skills around that will also be needed by organisations.
Well,
so
when
it's really,
you do take, can I just ask a quick follow-up? When you do take sort of the entire team along to an engagement, or where there's sort of different parts of the organisation there, what's the reaction and what's the kind of overall atmospherics? Does it change the nature of that engagement?
So I think that's a really good point, but I think that comes down to specifically the way we engage as a corporate, very bottom up. It's very like long-term relationships with the companies. It's very much known that we would engage in that way. So I think depending on the type of investment style that you have and the relationships and the access that you have to those companies, it's very much welcome because there's expertise in the room. So for example, if you're engaging the recent Woodside climate action plan vote, that would be looked at across the RIAA team, across the equity analysts combined, talking to the company. So insights to and from the company from both teams are very much welcome. And I think companies are understanding more and more, particularly with the mandatory disclosures that are coming globally, that it's very helpful to engage across the piece with the investment companies on these subjects. So they also can pick on our expertise as well.
Amazing. Look, I can't get through. I feel like I can't get through a conversation anywhere these days without Donald Trump coming up. And sign of the times, there is a question there in the Q&A about his re-election. You know, we've had the so-called ESG backlash starting in the US a few years ago, but this report actually shows that Australian managers have continued their commitment to ESG. So what kind of challenges or opportunities do you think Donald Trump's second term as US president is going to sort of cause for Australian responsible investors? Does it really matter, you know, in the general scheme of things, who the president is? Christine, I'll perhaps go to you first on that one.
Right. Well, I am Australian in spite of my accent, but I guess there's probably a lot that can be said in a whole session on this. I think what's most important and very relevant to the conversation we've had so far is, okay, if you don't want to call it ESG, if you want to call it something else, it's ultimately the core kind of capabilities below. It's really digging deep into risk assessments and opportunities. It's more metrics within an asset manager's capability. It's those skills that we talked about that, you know, they're there, and collaborating from methodology to execution. And that will, you know, drive longer term performance, we do believe. So I'd like to say from that perspective, it shouldn't make much of a difference. Hopefully we're not too distracted by, you know, terminologies and other things.
Yeah, and if I can echo that, I think there's an understanding, a baseline understanding pretty much globally from the clients that we speak to globally, that ESG considerations and an extra input to investment process, the research process, and it's additive. Those risks and opportunities, it's extra information. So I think the ESG element has probably been quite politicized. In fact, I was at a conference the other week where collectively we all discussed, is there another way of framing this? I think if you take a step back and say it's extra information to help inform an investment decision, it's very much for the end investor's benefit. People definitely understand that way. I would also say from being in Australia, my role's an APAC role, but very much based in Australia, it's very clear that across the region and also globally, the direction of travel is mandatory disclosures. For Asia, looking at taxonomies, pretty much all of the Asian countries have signalled that they will be bringing in disclosures. So there's a real groundswell, particularly around ISSB and the work being done there. But I think that horse has bolted on that front. I think people are very much on board.
On board, that is really good to know. Thank you. And I think that does go to another question that we received about funds changing the names of their funds, like whether that actually constitutes a move from sustainable investing. And I think the resounding answer there is no, it doesn't, regardless of the language that we're using. Although we have seen, with the greenwashing environment and product labelling coming in, the words that we use are actually really important. Now, I did want to sort of looking out into the future. RIAA's a mission-focused organisation. We aim to align capital with a healthy and sustainable environment, society and economy. What change would you like to see in the industry to support these robust approaches to responsible investment? Christina or Carolyn, are you able to comment? And Anisha, please feel free to jump in there as well.
Yeah, yes, I obviously think, quite a lot about allocations to natural capital for all the reasons we talked about, that holistic approach around nature, climate, and people. It's probably well known in Australia. I guess if you look at that 3.9 trillion of AUM out there, there's much, much, much less than 1% allocated in that space. When you look at somebody, like our parent company, long-term responsible investing in their DNA, they're 2 or 3% and higher. If you look at Australia, much of the investment in the natural capital space is coming from Canada, Europe, Japan, the US. And so I think that's a really good example to stop, pause, and reflect. Why is that? Performance, as I mentioned, enhanced through responsible investment practices. However, there is a little bit of patience in that capital that's required. And as you said before, Stella, I think there's probably another session on your future, your super, and is there complete alignment with the goals there relative to, the best possible holistic outcomes, at least in my space.
Yeah, I mean, again, to echo that, it's having a supportive regulatory environment that's aligned. I'm hopeful that will happen. I think it's really great to see direction of travel with the Australian Sustainable Finance Plan. We often see this in other markets where the government's signalling one thing, but existing regulation doesn't quite support, but it's recognised in time that needs to converge on the same goal. So I think that's probably one of the biggest sort of barriers to break down, is ensuring that what's in place is aligned.
I might echo that as well. It's one of our key policy positions, is that whole of government approach. So really having the government strategic objective in terms of moving towards a net zero economy being supported by all the different departments of government, whether it's Department of Climate Change, Energy, Environment and Water, and the environmental laws and EPA development and frameworks that are being set up, the First Nations Clean Energy Strategy that also TQ has, Treasury in terms of the new laws that come out, as well as amending existing barriers or existing laws which may act as barriers to that strategic objective. It really is around utilising all of those policy levers, not just adding new law, but looking at what do you already have and what might be that impediment and changing it. The other thing I might mention is that in terms of international alignment, it's going to become an operational and an access issue. If we don't internationally align, we will lose our ability to export or access different markets. And I think there is a real focus on attracting green capital, and I think that is really great. And building up the policy framework under Future Made in Australia to attract that global capital is a really positive sign in terms of government investment in this space. However, we have to also recognise that we have businesses that access other markets, and that ability to do so will be compromised if we don't align ourselves with the information that is expected in significant markets like the EU. So I think that international alignment, whole of government approach to this transition is really what will accelerate this momentum.
So that is really so important. Perhaps, Christina, any more comment on, we have most of the market at least practicing ESG integration. How can we encourage?
I think Estelle's cutting in and out a little bit again.
Oh, sorry. Sorry, I just had a follow-up question for Christina just around how do we encourage now? So hopefully that's a little bit better. How do we encourage more of the Australian market to engage in the natural capital space?
Oh, I think, first of all, many of the topics that we touched on, more alignment on transparency, many different forms of transparency does create some non-transparency. So guidance on reporting and methods. I couldn't agree more with Naisha, your feedback on a all of government kind of approach, so that there's alignment and, not concern that the rules might change a little bit later in the game. And also much of what adds benefit in natural capital to society, and you see that through natural capital accounts, much of it is not captured today through ecosystem services. So I do think continuing to advance, the progress through the carbon, the ECU market, but seeing that move forward in the biodiversity markets too can really unlock quite a lot of value, but probably with a realistic view on what it will take to generate the demand.
Absolutely. Look, this has been an absolutely fascinating discussion. With the tech issues that I'm experiencing, it might be a good time to leave it there. We've gotten through the questions that have come through. Thank you to those who submitted questions. It's been a great discussion. Thanks again also to Nuveen, T. Rowe Price, AXA Investment Management and EY for support to the project. Thanks to our panellists today, to the survey participants and to the report's authors, Bolgan Danda Van Jig, Nyanisha Samarakorn, Emma Hurd and Sally Shepherdson. Don't forget to download the report. It really does delve more into these issues. And we will be delving even more into these issues at our conference next year. Please get your early bird tickets now. The program is already shaping up to be a really fantastic one. Thanks so much, Carolyn, Christina and Nyanisha, for your insights today.